China stocks hit another circuit breaker as China has its worst start to a new year in 2 decades. Good morning and welcome to this edition of IG Live. It's Thursday, the 7th of January. As usual at this time, we are 10 minutes away from the start of today's trade and we are watching the markets ahead of the start of what is likely to be another very big decline at the start of the European markets today. We'll take a look at the numbers themselves in just a minute. I want to show you the FTSE chart first of all to show you where we are today, currently at 59.35. So expectations are that we'll see a drop to below 6,000 at the start when things get underway. Got a couple of interesting levels just coming up just a short way from where we are at the moment. 9.33 at the moment. We've got a little bit of support at 59.12, and then we go back to these lows that we saw back in China. The lows closing low at 58.58. So we are about 80 points or so away from that level there. And then after that, you've got to go back a long, long way to markets that we haven't seen since the 31st of December 2012 for the FTSE 100. So we're expecting a loss in excess of 2% in London. The German market's down 3.2% at the moment on from yesterday's close, and a more than 3% knock as well there for the French 40, the benchmark index in France. Let's look at what else is happening around the world. Some $2 trillion wiped off the markets in the last few days at the start of this year. Nikkei down a further 2.3% today. We saw the Shenzhen at the start today, or the Chinese stock markets, operate for 13 minutes before the first circuit breaker came in, and then another minute's worth of trade and another stop. But things settling out today with a 6.9% slide for the benchmark Shenzhen CSI 300. S&P ASX 200 down 2.2% on the trading day today. US closed yesterday. We were down in excess of 1% apiece for all the major benchmarks there, almost 1.5% down for the Dow Industrials, S&P 500 down 1.3%. Let's look at early US trade today. Wall Street cash down 1.6%, similar sort of move there on the US 500. US Tech 100 cash down 1.75%. Let's get an update now on where things have started out in this early trade on this Thursday. Off now to our Melbourne newsroom and Chris Weston.
Well, this wave of vulnerability, this wave of pessimism, negativity that seems to be spreading through the world's capital markets has probably caught another leg lower this morning. And really what we've been seeing through Asian markets is a continuation of this theme. And I think the buzzword that you've got to look at is disinflationary forces, potentially one day leading back into that deflation mindset. Have a look at the Fed minutes we saw that came out towards the back end of the US session. If you look at the key level that I'm looking at there, some Fed members saw considerable risks to their inflation forecast and outlook going forward. That to me really highlights what we've been seeing now. Now as the Chinese continue to devalue their currency, and I think the big catalyst today came in that fixing mechanism we saw where that midpoint was brought up, i.e. the Chinese currency was weakened by over 300 pips, significantly higher than what the market was looking for, a big weakening of about 0.5% of the midpoint. You know, we did see risk assets really coming off again. China are effectively exporting their deflation to the rest of the world at a time where other central banks really don't have enough firepower to actually lower their currency relative to the Chinese currency. And as that Chinese currency continued to weaken, risk assets really came off. The Aussie dollar weakened significantly against the Japanese yen. We saw that in all the other commodity currencies coming off quite sharply as well. US futures fell. And then we actually saw the open of the Chinese market at 12:30 Sydney time, and we saw the market really coming off quite sharply. In fact, after about 13 minutes of trade in China, the equity market was then subsequently hit the 5% 15-minute circuit breaker, and straight away after that it went straight into the 7% full day trading hold that we saw there. Risk assets caught another leg lower. We've seen big selling in oil, US futures, the ASX has been hit very, very hard today, although I say 14% of stocks are still up on the day. The market's down over 2%, which is a big move for us. You've got a worsening in the opening calls. Copper prices have come off, and everyone's been loving gold at the moment. There's been big buying coming through in the gold complex. People really want that safety there. So it's been a big risk-off day. China's right at the epicenter of this selling, and people are concerned just how much lower this Chinese yuan can go and what it means for the global economy and their ability to absorb China's deflationary exporting here.
Chris, thanks very much indeed. We'll pick up with some more detail on that FOMC minute release last night, and we'll also take a look at this in the context of some of the European economic data out today, including jobs, consumer confidence and retail sales. Do want to catch up though with some of the interesting stocks to watch this morning, because as in terms of some of the trading opportunities, Marks & Spencer, Persimmon, EasyJet and also Poundland. David Madden is with us this morning. David, first of all, we've got to talk about Marks & Spencer, because what some people have been saying should happen has seemed to come to pass, and the CEO has decided to retire.
Well, it comes as no major surprise that Mark Bolland is retiring from M&S. There's been questions over how long he's going to be leading the supermarket chain for a number of years now. And even though 2015 saw a year when it was the first time the company actually increased its underlying profits in 4 years, it's the same old story with M&S. Food sales is doing fairly well. It increased ever so slightly by 0.4%. Analysts were expecting a rise of 0.5%, so broadly in line. Apologies. But it's the same old story. It is the general merchandising, which is essentially the clothing department. Analysts had low expectations going into this. Some analysts had forecast a decrease of 2% on the period, some as low as a decrease as much as 5.5%, and a decline by 5.8%. Much worse than expected. That's going to be the major drag on M&S. There was some positive news though. If we look at the Christmas period, sales on the run up to Christmas up 17%. That's very impressive. And the man who's taken over the job is actually the former head of the general merchandising division. So Mr. Rowe is going to have a lot of pressure on himself, not only to turn around the department he used to run, but now the business as a whole. Now, it is worth noting that M&S, the share price has been on decline for the last year or so. I think that is going to continue. Today's update is also going to weigh on the stock, not to mention the fundamentals of the big macro picture. But also, the entire supermarket sector as a whole in the UK isn't great, and M&S was probably the best of a bad bunch. But still, I do think we are going to see further pressure to the M&S share price. If we just have a look at the chart, we can look at sort of certain levels we should be watching out for. We noticed there that the stock has been in decline since last May. I think given that we're calling the FTSE down about 2%. Also, the poor clothing numbers is going to really weigh on an M&S as an individual stock. So I see the stock heading towards £4.13, and then the psychological £4 per share will be the next level to watch out, and then the next support level to watch out below that will be £3.81.
Yeah, okay, it's Marks & Spencer in amongst the mix this morning. Also, Dave, we've got to talk about Persimmon, the house builder, one of the better performers on the FTSE 100 last year. And it's actually holding up relatively well at the moment so far this year, bearing in mind the big declines that we've seen. It's come out with another set of really good figures, as one might have expected.
If anything, today is a day, an opportunity to actually buy into good performing stocks on a day when the overall macro picture is quite poor. So as I say, the FTSE is down, we're calling it down about 2%, therefore the entire broad picture, we're looking at stocks lower. Persimmon is a company which has been rising steadily for a number of years now. Everything is going well for this company. Revenues are up, completions are up, average selling price is up, all down to the simple fact that supply of houses, particularly in southern England, is low. Demand is very, very high. Banks are willing to lend. Customers are willing to actually go out and borrow and take on extra debt. And most importantly, the government has policies in place which are actually suiting people getting on the property ladder. Any kind of uncertainty in the UK economy is only going to defer the Bank of England from raising interest rates. There's already talk it may not be till 2017 we couldn't see Mark Carney move. Everything is moving in the right direction for Persimmon. So on a day like today, if you're looking at maybe on a stockbroking account, or even for a more medium-term spread bet on a futures contract, today could be an opportunity to buy into a stock like Persimmon. So the levels to be watching out for Persimmon should be pull back lower on this company. It's somewhere in the region of £17.71 is the support level we should be looking out for, and then obviously the record high of £21.55 will then be the target to the upside.
Yeah, okay, just a couple of stocks there we're watching. Also want to mention two others. Poundland is one worth looking at today. This company has reported what it says is a 29.4% rise in its overall sales. If you include some of the currency movements, that's 30%, but that includes the 99p stores acquisition. So don't be fooled into thinking that Poundland has scored a massive rise in sales. It's because they've been adding weight through the purchase of 99p. Expecting full year pre-tax profits at the low end of expectations. So this is very, very close to a profit warning. I'll get into another stock in just a minute. European Open just happening now, down 2% for the London markets. We'll take a look at those two FTSE 100 stocks in just a minute, Persimmon and M&S. Germany 30 cash down 3%, a near 3% slide for the France 40 cash. Just one other stock I do want to talk about just as we go into the start of trade for a number of these companies. We are going to be watching EasyJet as well today. We have got a drop in the load factor of 1.8 percentage points for this stock. Now, this company has been doing so well recently. I don't think we've got an open yet for the stock of EasyJet. Is that today's trade? Is not yet open for the session today. But EasyJet's one of these companies that's been looking at the oil price, because we've got oil down heavily. In fact, it's down a further 6% today for the price of Brent. We'll take a look at oil in just a minute. But it's been capitalizing today on the last year or so, I should say, these low oil prices. They've been locking in these low oil prices. They've been hedging, hoping to get lower and lower oil prices. And EasyJet's been one of these stocks that's benefited from this. Oil is a massive cost for these airlines, and it's been capitalizing. The stock is down 1.75% for EasyJet at the start there today. So it's one of the negative shares, but I suppose in the context, one of the better performers of the markets. Let me just quickly catch up with another stock that we've got, which has just opened for the trading day today, and that is the stock of Marks & Spencer. That is down 0.75%, but in the context of the overall broad market, that stock is better off because we're down 2% for the benchmark index. So the 0.75% drop for Marks & Spencer is an outperformance. So Marks & Spencer considered against its benchmark to be doing better than the market itself on which it trades. So Marks & Spencer down 0.75%. Just want to quickly update you as well on Persimmon. That stock has opened with a drop of 1% as well, but again that stock is above the benchmark, above its FTSE 100 counterparts for the session today. So despite the fact it's down, it's not down as much as the FTSE 100. I want to quickly check on Poundland as well. I don't think we've got an opening trade on Poundland at the moment, but it looks like we're going to see an early lower start today. That's gone into auction, so we'll see how Poundland opens, but those figures this morning could be taken as a big disappointment. So Poundland waiting the start of today's session. Now we're going to get back into some more stocks in just a minute. I want to take a look at Netflix as well, which is a big outperformer last night. But what I do want to do is I want to bring it all together and take a look at some of the economic data. The Fed raising interest rates was a close call last month, according to the minutes out last night, revealing that the decision to raise rates, which the Fed kept near zero for 7 years, was unanimous, but some officials expressed concern that inflation would linger below their 2% objective. Now that's in the economic mix today. Also, there's weekly jobless claims in the US, and there's a raft of European economic data, including consumer confidence. We've got Eurozone retail sales and also jobs numbers. David, what's the trade of the day on the currency markets?
The big focus is going to be on the euro dollar. We have retail sales off from the Eurozone, as we do unemployment from the Eurozone, which is tipped. It's expected to hold steady at 10.7%. We had some CPI numbers from the region as a whole not too long ago, and it's broadly speaking holding steady in the Eurozone. Obviously, CPI is going to be an issue for the future changes or alterations to the ECB's easing policy. For the time being, the euro dollar is probably going to continue in the downward trend that it's been in since the middle of last month. Things to watch out for today. Obviously, we got two announcements from the Eurozone. Jobless claims in the US at 1:30. Keep bearing in mind ADP numbers in the US yesterday were very good. Tomorrow is a jobs report. But seeing as the Federal Reserve seem to be a bit hesitant in their liftoff of interest rates as the minister revealed last night, I wouldn't necessarily say we're going to see a major collapse in the euro versus the US dollar, given that it seems to be a bit of it was a close call to borrow their phrase. But seeing how much selling pressure we've seen in equity markets today, we could see the classic flight to quality into the US dollar, and therefore even if the numbers from the Eurozone are holding up okay, and there's nothing to suggest that the ECB are going to extend or expand their existing policy, just purely because of the flight to quality factor and strong numbers from the US, in my view, will continue to push the euro lower versus the greenback.
Yeah, okay, all right, so euro dollar at the moment at 107.85. What I want to do is we can bring the chart back, because I want to take a look at this in 1 hourly chunks so we can see where this the Fed last night came out with that announcement. Here we are. I'll just draw a vertical line on that so we can see exactly what happened. And we saw the euro gain, because the Fed weakened against a number of currencies, including the euro, as David was saying, because there was a hesitancy in the tenor, if you like, or the tone of the minutes last night, despite the fact that it was a unanimous decision. Obviously, some concerns raised about that. Are we going to get any more interest rate rises this year from the Fed? That's going to be the next question, David.
I think the trade for the euro dollar is all about selling the rallies. Basically, so it's obviously watching out for, should we push higher up towards 108? That's going to be an opportunity to sell into strength. And then should we move beyond 108, we should also be looking at area levels such as 108.70 and then again 109.04. But the downside target for the euro dollar initially is going to be 106.30, and then should we move below that, we'll then be looking back towards the 105 region.
Yeah, okay, that's trade there for the euro dollar. Watching that today, we've got, as I said, a number of bits of data out. 10 o'clock this morning UK time, we get that European data, and at 1:30 we get the weekly jobless claims, and of course that time tomorrow I should say, it's the jobless figures. We'll be talking to Wei Li from iShares at BlackRock at 1:30 p.m. tomorrow for the release of that non-farm payroll data. Quickly want to go back to some of these stocks on the move this morning. Just want to go back, if I can, to take a look at what's happened to Poundland. We do have a trade there today. That stock is down 7.5%. It's a FTSE 250 company. And this stock is on the way down after, as I said, what is perceived as very poor figures. Bearing in mind they've acquired 99p stores, despite the fact they've got a big uplift in overall sales. When you take out the 99p store acquisition, looking like they're going to see profit towards the bottom end of expectations. So Poundland. Let's take a quick look at the movers across the European markets, because very, very interesting. No gains at all. Anglo American, worst performer, down 10%. This is one of the companies that suspended dividends a while back. Glencore, ditto. Aberdeen Asset Management also on the way down today. BHP Billiton, Antofagasta. Let's take a look at the FTSE 250, and we'll see there that we've got some gainers, but to be honest with you, the stories are all on the way down. Poundland Group 7.8%. Premier Oil, out with actually some information I saw this morning, went across the wires, down 13%. Tullow Oil, Vedanta, Ophir Energy. It's got a real commodities flavour to some of these stocks on the way down today. Do we have the European markets? Let's take a look, if we can, at what's happening in Germany and France as well, because if for no other reason, we are just monitoring which stocks are leading the declines. Not that we're looking at any of those on the way up, and indeed in the German markets at the moment, none. Deutsche Post, worst performer, VW, BMW, Continental and Daimler. And on the French markets as well, the biggest 40 stocks trading in France, no gainers. Peugeot, worst performer, down 4.5%. That's it for this edition of IG Live. We're back at 10:30 this morning. Hope you can join us for that. It'll be Chris Beecham this morning taking us through some of the technical analysis on some of these charts. And if you look at some of the long-term pictures, we're still not at recent support. So potentially there is some more downside to go. Don't forget that if you are trading these markets and you're looking for further declines, do put those stops in place. If there's a snapback, you could potentially lose a lot of money, but what the story is there is the fact that we're watching these markets closely, and do operate the systems that are put in place there for you to give you some sort of safety support. That's it for this edition of IG Live. As I say, back at 10:30 for Charting the Markets.